Hi everyone, today we'll be going over accounts February-March 2020, paper 3-2, question number 5. This is structured paper 3 which consists 6 questions, each of 25 marks, and we are also given a time limit of 3 hours. So we will be attempting to solve each question under 30 minutes. And this question number 5 is a part of section B which deals with cost and management accounting. So without any further delay, let's get started. The sales budget of Z Limited for 5 months to 31st May 2020 is as follows. So we are given the number of budgeted sales units for the month of January, February, March, April and May. And we are given following information. Finished goods inventory at the end of each month is equal to 20% of the following month's sales. So this just means that if we are trying to figure out the finished goods inventory for the month of January, that is going to be 20% of the sales units in February. Okay, then the second information states that each unit of finished goods requires 3 kilos of direct materials, and direct materials are purchased every month. And the very third information states that direct materials inventory at the end of each month is equal to 10% of the following month's production needs. So this is the same case as the first one. If you are trying to figure out the direct materials inventory at the end of January, then that will be equal to 10% of February production needs. Okay, now let's have a look at our first question. For the first part, we need to explain the meaning of the term master budget. And master budget is essentially a financial plan of the company as a whole, because as the name suggests, it is master, right? So it should include company as a whole for the upcoming year or upcoming period, which summarizes the plans the company uses to achieve its strategic goals. Let's write it down. Financial plan of the company as a whole for the coming year which summarizes the plans the company uses to achieve its strategic goals. Now, for the second part, we need to state two components of a master budget other than production and purchases. The very first one could be sales, because like we are given above, we are given a sales budget, which is a component of master budget. And above, we are also given information regarding direct materials. So we could also create a direct materials budget as a component of a master budget. Let's write it down. Alright, now this concludes the first part of this question. We can move towards the second one. For the first part, we need to prepare a production budget in units for each of the months of February and March 2020. Okay, so this is going to be for March, this is for February. And we are trying to figure out the production budget in units. So this just means that we need to figure out the number of units that we need to produce for each of the month of February and March 2020. So the very first thing that we will be starting with is going to be sales, because obviously if we are selling those goods, then those goods need to be produced as well, right? Then the next step would be to add all of our closing inventories. And we are adding closing inventories in order to figure out the production budget, because this is the case when, if you're talking about the month of February, then the closing inventories are the units that are produced within this particular month but have not been sold yet, right? So this should obviously be included in our production number of units for the month of February. Then the next step would be to subtract all of our opening inventories. And we are subtracting all of our opening inventories because it has the same explanation as the closing inventories. The closing inventory of last month is going to act as the opening inventory of this month. So that means that those particular inventories were produced in last month rather than this month. So this should not be included in our production units for this particular month. That's why we will be subtracting our opening inventories. And this will give the total number of units to be produced for each month. So that's units to be produced. We are given the sales units for the months of February and March in the above information, so I'm just going to substitute it. Okay, we can see that for February, the sales unit is 4,000, whereas for March, it's 4,800. So let's write it down. That's 4,000 for February and 4,800 for March. And we were also given additional information regarding the closing inventories for each month. We were told that finished good inventory at the end of each month is equal to 20% of the following month's sales. And we need to figure out the closing inventory for the month of February, which means that this is just going to be 20% of the sales units for March. So for February, the closing inventories is just going to be the sales units in March, which is 4,800, times 20%, which you can write down as 0.20. And this results in the value of 960. This is the closing inventory for the month of February. Now we repeat the same process for the month of March, and that will be 20% of the sales units in April. So in this case, that's 4,400 times 20%, which results in the value of 880. Let's substitute these two values into our statement. That's 960 for February and 880 for March. Now we need to write down our opening inventories as well. And like I said before, the closing inventories of last month is going to be the opening inventory of this month, right? So in case of March, its opening inventories is going to be the closing inventories of February. So I'm just going to write down 960, and this should be subtracted. So I'm just going to write it down in a bracket. Now for the opening inventory of February, that should be the closing inventory for the month of January, right? Which means that we need to figure out our closing inventory at the end of January. Okay, and that is just going to be 20% of the following month's sales. In this case, that will be 20% of February, right? So that's 4,000 times 20%, which gives the value of 800. Let's write it down. Now we can easily figure out the units to be produced for the month of February as well as March. For February, that will be the sum of these three months. 4,000 plus 960 minus 800, which results in 4,160. And for the month of March, that's the sum of these three months. 4,800 plus 880 minus 960, which results in the value of 4,720. Okay, now we can move to the second part, and we now need to prepare the purchases budget for the month of February and March 2020. So this is for March and this is for February. Okay, we already have the total units to be produced, right? So I'm just going to write it down. And this is the purchases budget in kilos, which means that this should be the budget relating to our direct materials. Okay, let's write down our units to be produced. So for February, that's 4,160, and for March, that's 4,720. Let's write it down. That's 4,160 and 4,720. And we were given information regarding our direct materials above, right here. Each unit of finished goods requires 3 kilos of direct materials, right? So we already have the number of units to be produced each month. So we can just multiply 3 kilos to each of them in order to figure out the total raw materials required in kilos. Let's write it down. So that's the raw materials per unit, which is 3 kilos. Okay, now we can easily figure out the total raw materials required. And that is just going to be the product of units to be produced and the raw materials per unit. For February, that's 4,160 times 3, which results in the value of 12,480. And for March, that's the product of 4,720 and 3, which results in the value of 14,160. Okay, these are the total raw materials required for this month, but we are also given the information regarding the closing inventories of our raw materials or direct materials right here. Direct materials inventory at the end of the month is equal to 10% of the following month's production needs. Okay, so like we did before in our production budget, we will be adding our closing inventories of direct materials because obviously those are purchased in this particular month, and then we will be subtracting our opening inventories because those were purchased in last month. Okay, I'm just going to write down the format first. Let's add the closing inventories and then subtract the opening inventories. And this will give the total purchases of direct materials. I'm just going to write it down as direct materials to be purchased. And we are told that the closing inventory of this month is 10% of next month's requirement, right? So for February, that's going to be 10% of the raw materials required for the month of March, which we have right here. Let's figure out its 10%. That's 14,960 times 10%, which you can write down as 0.10, which is also in the value of 1,416. This will be our closing inventories of the raw materials for the month of February. That's 1,416. And now closing inventory for the month of March is going to be 10% of the raw materials required for the month of April, right? So for April, this is the workings. We first need the total units to be produced in the month of April in order to figure out the total raw materials required for the month of April, right? So let's do our workings in our production budget. For the month of April, we'll start with the sales value, which is given above. For April, that's 4,400. Let's write it down. And now we need to add the closing inventories of April. And we know that the closing inventories is just 20% of next month's sales. In this case, that will be 20% of the sold units in May. So that's 5,000 times 20%, which you can write down as 0.20, which results in the closing finished goods inventory for the month of April to have the value of 1,000. Let's write it down. And for opening inventory, it's just going to be the closing inventory of last month. And the last month is March, which has the closing inventory of 880. I'm just going to subtract this. Now we can easily figure out the units to be produced in the month of April by adding these three amounts. That's 4,400 plus 1,000 minus 880, which results in the value of 4,520. Let's substitute this value into our purchases budget. So that's 4,520. And we need to multiply it with the raw materials per unit, which is 3. And now the product of these two amounts will give our raw materials required for the month of April. That's 4,520 times 3, which results in the value of 13,560. Now we can figure out the closing inventories for the month of March. That is just going to be 10% of the raw materials required in the month of April. Let's figure it out. That's 13,560 times 10%, which results in the value of 1,356. Okay. Alright, now we need to subtract the opening inventories. And like I said before, this month's opening inventory is just going to be last month's closing inventories. So for March, that will just be the value of closing inventories for February. That's 1,416 in a bracket. Now, if you require the opening inventories for the month of February, that is just going to be the closing inventory for the month of Jan. And the closing inventory for the month of January is just going to be 10% of the raw materials required in February. So that's 12,480 times 10%, which results in the value of 1,248. And this will now act as our opening inventory for the month of February. Let's write it down. Okay, now we can easily figure out the direct materials to be purchased by adding these three amounts. That's raw materials required plus closing inventories minus opening inventories. For February, that is 12,480 plus 1,416 minus 1,248, which results in the direct materials to be purchased to have the value of 12,648. And for the month of March, that's the sum of these three amounts, 14,160 plus 1,356 minus 1,416, which results in the direct materials to be purchased for the month of March to have the value of 14,100. Okay, this concludes the second part of this question. We can now move towards the third one. We are given additional information. There will be an increasing trend in the purchase price of direct materials. The purchase price of direct materials for the first 3 months is expected to be as follows, alright? And then Z Limited adopts the first in, first out method to value direct materials inventory. So first in, first out just means that whatever direct materials will be purchased first will be used first. Now for the third part of this question, we need to calculate the budgeted cost of direct materials consumed for the month of February 2020. Alright, so I'm just going to create a statement. And this is just going to include the opening inventory for this month, direct materials purchased in this month, and the closing inventory of this month, right? So we start with the opening inventory. we add the direct materials purchased. And we then subtract our closing inventory. And this will give the cost of raw materials consumed. Okay, let's have a look at the opening inventory for the month of February, which we have calculated before. Right here. The opening inventory for February was 1,248 kilos, right? And like I said before, this opening inventory for February is the closing inventory for the month of January, which means that these were purchased in the month of January. And we are given the purchase price for January right here, which is 3.25. So in order to figure out its value, we just need to multiply the number of kilos, which was 1,248, to the price of January. So that is just going to be 1,248 times 3.25, which results in the value of 4,056. This is the value of opening inventory. Let's write it down. Now let's have a look at the direct materials for the month of February, or the direct materials to be purchased. And it amounted to 12,648 for February. And these are the direct materials to be purchased in this particular month, which means that in order to figure out its value, we just need to multiply it with the rate for the month of February, which is 3.5. Right? So that's going to be 12,648 times the rate of 3.50, which results in the value of 44,268. Let's write it down. We need to add it. Okay, and the next step will be our closing inventories. Let's have a look above. Right here, we can see that the closing inventories for the month of February is 1,416. And these are the closing inventories, which means that these were purchased in the month of February itself, right? So in order to figure out its value, we just need to multiply it with the purchase price for February, which is 3.5. So that's going to be 1,416 times 3.50, which results in the value of 4,956. And we need to subtract our closing inventories. So I'm just going to write it down in a bracket. Now we can easily figure out the cost of direct materials consumed by adding these three amounts. That's 4,056 plus 44,268 minus 4,956, which results in the value of 43,368. This concludes the third part of this question. We can now move towards the fourth one. And we can see that we are given the working section. So instead of scribbling all of the question paper like I did, you guys should be showing all of your workings in this particular box. Now for the fourth part, we need to explain the impact on profit of using FIFO and average cost in the circumstances of rising direct materials price. Okay, so let's write down how these are treated in FIFO first. As the name suggests, whatever direct materials that we purchase first will be used first, right? Which means that, as in the statement above, earlier material prices charged to the cost of raw materials consumed, right? Like in the opening inventory, we charge the price of 3.25, which is lower as compared to the charge for February, which is 3.50, right? Let's write it down. Earlier material prices and these will be the lower prices, right? Are charged to the cost of raw materials consumed but we also know that the closing inventory will be valued at the latest price, which will be higher. Let's write it down. Closing inventory is valued at the latest prices, and these latest prices are higher, right? So that's higher prices. Now let's write it down for average cost method. And as the name suggests, we know that we will be charging the average cost, which will be the average of lower prices and the higher prices, to our cost of raw materials consumed. Let's write it down. average cost, which is the average of lower prices, and higher prices, is charged to the cost of raw materials consumed. Right, and this just means that our closing inventory will also be valued at the average cost. So closing inventory is valued at the average cost. Now we actually need to write down the effect it has on our profit. And whenever we are talking about profit, closing inventory is actually added in order to figure it out, right? So higher the closing inventory value, the higher the profit will be. And in this case, we can see that for FIFO, the closing inventory is actually valued at the latest price, which is the higher price. But in case of average cost, the closing inventory is valued at the average cost, which is the average of lower prices and higher prices, which will obviously be lower than the higher prices. In this way, we can conclude that FIFO has a higher closing inventory value as compared to AVCO method, which is why the profit using FIFO method will be higher than when using AVCO. Let's write it down. Profit using FIFO method will be higher than when using AVCO because FIFO produces a higher inventory value than AVCO. Okay, this concludes the fourth part of this question. We can now move towards the fifth one. We are again given additional information. The marketing manager of the company is of the opinion that due to the unpredictable economic climate, it is not worthwhile to prepare a budget. We need to discuss whether or not the marketing manager's opinion is correct. So we know that budget is basically the blueprint that guides the company and motivates its people as well. Let's write it down. Budget is the blueprint that guides a company and motivates its people. But at the same time, we are talking about unpredictable economic climate, which means that there is a changeable economy. So it is quite difficult to prepare a budget in such condition. Let's write it down. It is difficult to prepare a budget in a changeable economy. Now we need to decide whether or not the marketing manager's opinion about preparing a budget being not worthwhile is correct or not. So whatever the condition is, budget is the blueprint that helps in coordinating the people as well as motivating them. And regardless of how difficult or how costly it is to prepare them, it can be fruitful in the future. So I'd say that it is worthwhile to prepare a budget, which means that the marketing manager's opinion is incorrect. Let's write it down clearly. The marketing manager's opinion is incorrect. Okay, this concludes the fifth part of this question as well as the entire question. If you found this video useful, make sure you like the video and leave a comment below, and make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.